Thanks, Janet. I don't know if you could see it.
I
I'll be
was
doing a
just
little.
I was just telling Chris and I, we were just talking. I was just telling them, like, I was reading this article this morning, and it seems like last time, and back in July when Powell was speaking, his comments were misinterpreted by investors, where he was talking about like a near-term policy pivot, but that's not happening until after 20 or the new year, like until after
Hmm.
January 2023. And so what a lot of people essentially thought was that they're going to end up doing it probably in November or December, where they're going to start pulling back to 50 basis points. And so I was just saying, like, it doesn't make sense right now to come down to a 50 basis point. So today we know for a fact that's going to be a 75 basis point hike. And now I think going into December, the next question is right up top here whether it's going to be a big move like a 75 basis point hike or coming back down to 50 basis point hike. And I
Hmm.
think the 50 basis point hike in December makes a lot more sense because
Hmm.
then going into the new year, the target that they have for March 2023, it's going to give them a lot more room if they end up coming back to a 50 basis point hike in December. And usually, like around holidays, especially end of the year, a lot of the central banks either they don't increase rates or they increase it at like very slow pace. And so that's why when Bank of England increased their rates last holiday, it caught the market by surprise when they increased their rates so aggressively. And so
I
I
remember
think,
that.
yeah, and so I think this time it makes a lot more sense to go in with a 50 basis point hike in December, and then same thing maybe in January, and then come in a little bit more aggressive as you're getting closer to March, April timeline to come in more aggressive if need be. But I think regardless, inflation is still going to be up there until January because of the holiday spending and whatnot.
Yeah, this is exactly what I was saying on the breakdown yesterday when it comes to December and how we could possibly have a 50 basis point increase. We
Yeah.
never really know for sure until the data actually comes out. So, I mean, if we did have that 50 right now in November, I highly, highly doubt it. It still could happen though, and that would be a big surprise. It'd be a big reaction in the market that we'd probably be able to catch a nice move from. But
Mm-hmm.
odds are it's going to be 75 basis points, and that's going to be neutral. So we're not going to have that big of a move. Price is still going to continue to consolidate. We might get a little move on the lower time frames, but most people, and the whole week we're really waiting for this FOMC statement right now. So most people understand that it's probably going to be 75 basis points. But like you were saying, as soon as I came in, when it comes to inflation and holiday spending, inflation's still going to be up when it comes to holiday spending. We saw ADP come out today. Employment is, it was a nice little surprise number, a little bit bigger than expected.
Yeah.
But when it comes to holidays, everyone's spending. People are spending. They don't care, right? Just like the consumer throughout the entire year, most of the time doesn't care because they're spending on emotion. They're spending because they just want to buy things, and they're not thinking about their bank accounts or the future. But especially during the holidays. So inflation, I mean, if it keeps going up and up and really hurting people's pockets, which people might be feeling shortly if they're not feeling it already.
Mm-hmm.
It's going to be an interesting holiday season to see how much our GDP and how much retail sales go up.
I think people are feeling it already. It's just like you said, an average consumer is still going to go out and
Definitely.
spend money regardless, right? Now the thing is that around holidays, it just amps up a bit more. And that's because now
Amplifies.
you're getting it for your friends, you're getting for your family, your loved ones and stuff like that. And obviously people are just going to go out and spend a ton of money, especially around the holidays. Plus you have like the seasonal employment. So that's why when Jolt's job openings came out, I wasn't really surprised when that data came out better than expected. And that's because now you're starting to see those seasonal jobs already opening up. But now the question is that are these the jobs? Last time when we looked at challenger job cuts and we looked at job posting this and that, they were actually taking job postings off of the market. So those jobs weren't even being filled. And now the question is, are you just putting those jobs right back onto the market? Is that the same thing? Or are you actually seeing additional jobs? And right now, it's going to be hard to decipher that because of the seasonal jobs that are going to be opening up.
100%. Yeah. Well, I mean, like you said, I think budgeting really goes out the window during holiday season. So,
Yeah.
like I said, it really depends on what retail sales are going to be coming at it, and that'll be interesting to see. But
Yeah.
again, I think this will be a 75 basis increase. Wouldn't be surprised if December is as well after seeing that spending,
Mm-hmm.
just to bring the demand down. So we shall see. We
Yeah.
trade based on what we see.
Exactly. I think regardless of whether it's a 50 or 75 base point, like the inflation is still going to sit up there at least until January.
Yeah, yeah. Until you start getting that interest rate up near the uh, what's it called, inflation number, it's probably not going to go down too much.
Yeah, and I do think that they're going to end up increasing their range from like a 5% target to, it has to be higher than 5% in
Mm-hmm.
order for them to even make any significant dent into inflation.
Yeah, and then that's not good for the market.
Yep. So then this was another quick article. I'm not gonna like read through the entire thing with you guys, but basically if you were to look up the same exact title, this is the stuff that we have been talking about for the last couple of weeks in our weekly outlooks and even in our live sessions, how Bank of England monetary policy, it's not working as they want it to work, and that's because of the difference between what the government was doing and what the central bank was trying to do, and how the central bank, yes, they're completely separate from each other and independent of each other, but the fact that when you're looking at, for example, the Fed, right? The Fed has the FOMC, that's part of it. The FOMC has to look at what's happening from a fiscal plan, and they're also going to look at, how is that essentially affecting the economy, and then they're going to be coming up with those monetary policies. So they're independent of each other, but think about it like the central bank is pretty much playing cleanup at this point if the government is not in line with what they're trying to do. And that's essentially what Bank of England was having an issue with. So that's what this entire article is about. I'm surprised it took them this long to come out with the article, because we've been talking about this for a very long time. All the data was there, all the signs were there that this thing is not working. All right, Steph, I'm gonna let you share your screen. Go for it.
Sounds good. Just trying to take a look at YouTube to see how this thing loads. There we go. All right. So we're gonna start off with gold over here, and then I'll hand it off to you for US 30. Now, just keep in mind when it comes to the interest rates and what we're expecting over here. Let's see. I'll just draw on the chart right now. So if we get a 75 basis point increase, right? Just so that you guys have a visual of what to expect if we get, the 75 basis point increase, that's going to be neutral for the market and dollar bullish. So you guys can see that. Now, if we get a 50 basis point increase, that will be market bullish, because people, obviously it's a big surprise in the market. People are not expecting something like that, and that's going to obviously bring the dollar down. It's going to bring gold up. You're going to see gold rally quite a bit. We may actually end up changing structure over here. So 50 basis point increase is dollar bearish. Markets bullish. And gold bullish. All right, and then if we get a 100 basis point increase, which I doubt will happen, but there have been some talks of that because inflation is so bad, basis point increase, that will be dollar bullish, markets bearish, and gold will tank. All right, just so you guys have that visual right now and understand where price could possibly be going, especially for YouTube. I know you guys know all this, but anybody beginning their trading journey and really the first time trading FOMC, so they have that visual and know exactly what's going to be happening. But looking over here, as far as the markets are concerned and technicals, looking at the monthly, the reason why we've been extremely bearish over here on gold is because of the interest rate hikes, right? Russia invades Ukraine. Ever since then, Fed introduces rate hikes, and ever since then, we've been pushing all the way back down to 16.15 so far right now. Right, 16.15, 16.30. We're still holding the support so far. You'll see it in the lower time frames, like the weekly here. All right, we're failing to break below 1630 over here, holding a strong support. Keep rejecting that area. We ended up holding a nice resistance at 1700. All right, strong bearish push down to retest the low. We continue to retest the previous wick over here. Barely get down there. We didn't quite retest that wick, but we ended up flipping bullish and closing bullish here. Then we get that liquidity grab where the candle ends up closing bearish, right? But still rejected that area. And then current weekly candle ends up grabbing liquidity down here so far at least, flipping bullish and now holding this support so far. Basically just waiting on the FOMC statement. So looking at the daily now we can just move this because obviously that's not our most recent support. Our most recent support is somewhere in here. But the entire area over here, what we've been doing is holding a strong support in this area and creating also some higher lows over here. You can see some of that bullish pressure coming in. Maybe that's because they're expecting in December that 50 basis point increase, and you could see gold start to rally if that's the case. Now, gold is still bearish on the macro sense and on the higher time frames over here, but if we get a big surprise like that, or even a surprise this month today, you could definitely see gold starting to rally and breaking certain previous resistances up here. You see what we have to the left over here?
I think the most important thing today, not just like the interest rate hikes or even the monetary policies, because we can already kind of figure out what they're going to end up saying in those policies. I think the most important thing is how the investors end up actually interpreting Powell's comments this time instead of misinterpreting it like they did last time. And so that's going to give us a better understanding. From a technical side, you're already tapping into 1620. You know, none of this is like a fake out or anything like that. It's legit just price making a new low. You're still in that overall downtrend. But if you were to hop back up real quick to the weekly and monthly time frame stuff, you could see like how we've been in a massive sell-off and now the market's just collecting liquidity and it's holding on to such a strong support even on that weekly time frame that we are bound to continue pushing back up just for corrective moves. And I think a lot of this push is going to come from, again, the Powell's press conference and what does he end up saying. Now, it's not going to be what he's saying that's going to cause a reaction, but it's exactly of like how the investors are going to understand what he's saying and what does that essentially mean for the next couple of months.
Yeah, that's where you're going to get the big move. I mean, again, most of us expect that 75 basis point increase. If that comes out at 2 o'clock, which we got about 16 minutes left, if that comes out at 2 o'clock, then the market's going to make maybe a little move real quick, and then the real move is going to come during the press conference if he says anything surprising about December.
Yeah.
That's where you're going to get that move. So most of the time with FOMC or NFP, if you guys, or mainly FOMC, if you guys wait for 3 o'clock normally, right? Press conference starts at 2:30. Right around 3 o'clock, if you get a trend going right now, you can really follow that trend around 3 o'clock and trade the reaction to the press conference. Because if you're in a trade during that press conference, he could say one thing that sets your trade completely off and hits your stop loss. But if you're really waiting to see what his main sentiment is in the first 15 to 30 minutes, you know, if you have that trend going, you might be able to grab a trade around 3 o'clock, and that'll be something nice for you.
I'm sure like a lot of the people who are here on Zoom could tell you guys that's exactly what happened last time when we were trading. I don't know if Pat's on here. Is Pat here? But
yeah, I'm here. I'm a late comer.
Look who it is!
What's up, guys?
You remember last time when we were trading interest rates, we were talking about like we're legit like on 5 minute, 1 minute time frame as Powell was speaking, and we were talking about like watch this is gonna happen and that's gonna happen, and it actually did end up happening. And then after that, that's when we caught the bigger move. Do you guys remember that?
Yeah, September.
I definitely remember.
Yeah, it's gonna be the same exact thing this time too.
We all traded together, right?
I think so, and then we hopped off, and I think I was still trading with the group afterwards.
Okay. Awesome. Well, let's see what we get today. Again, 15 minutes right now. Let me go to the economic calendar here real quick just to pull it up. All right, awesome. Expected 4% for interest rate, but again, coming down to these lower time frames here. I think we were on the 4 hour. We had a nice little rally to start November. Right, and that could be that top wick maybe on the monthly candle, right? And now we're holding that resistance here at 1660, grabbing liquidity, and then maybe we could continue down. Last 4 hour candle ended up closing a very strong bearish candle right over here. So looking at the 1 hour now, Looks like so far we're holding structure.
Steph,
In
if
this
I
one?
could ask you to just mark off, that little support, but like tighten it up a little bit, because that's the same exact
Which one?
level. The zone that you just marked off.
Yes.
If you could tighten that up, I would say like right around here, because then later on, like once you're done explaining the 1 hour time frame, I'm gonna ask you to hop back up on the 4 hour.
Okay. You're saying area to the left over here?
Yep.
Oh yeah. Could go even more left. Yeah, is that what level is that? Yeah, 1646. Yeah, something like that, right?
Yep.
Multiple reactions to that area. So again, price is just kind of consolidating. It has been pretty tricky trading gold. Let me take some of this stuff off too, because it gets a little. I don't like these thick zones here as a scalper. There you go. As we had that support formed right at the end of October here, we've been rallying, creating higher lows and higher highs so far. All right, so now we're holding the support over here. Are we grabbing liquidity to then end up, creating that top wick and then end up tanking over here? Obviously, after that 70 basis point increase. But again, I don't think we're going to see that big of a move. You're going to see a move. It's going to be quick, but and that's where you could possibly sell stop, or maybe even a buy stop if we have a surprise move. But I highly recommend anybody on YouTube. We got about 24 people in there right now. And then we got 23 of you guys on Zoom. Guys, don't trade the news coming out. You're gambling. Just wait, right? You don't have, you may have some good profits to start the week, right? Monday through Wednesday, you may have had some nice trades. I hate to see you guys blowing that, just trying to gamble on the news, just because you see other people doing it possibly. All right, just wait for the reaction to the news. Wait 15, 20 minutes. Wait for the press conference to come out and see if Powell says something surprising. And then, you can wait and take a very nice trade at that point. And now, if you don't get any trades today, don't be too hard on yourself either, because now you go and journal the trade that you would have taken. And then later on, either tonight for Asian, to see how the market reacts tomorrow morning for the Asian session for anybody out in Asia, you wait for that, where you could very well grab a move and then, live to see another day, Thursday and Friday as well.
Absolutely, and such an important week where you got UK interest rates coming out tomorrow, and then after that you got NFP coming out. If you're someone who's traded interest rates for a very long time, and you can already kind of, at one point, I'm going to be honest with you guys, at one point you could already tell what are the type of monetary policies they're going to start putting out, what are they exactly going to say, and what are the rates that are going to be coming out, the range. And then you can also tell from a technical perspective, which way is price going to move. After a certain time, I'm going to say, if you actually put in the time for at least 2 years and you treat this thing like it's real, it's like a real business, and you put the time in and you try to, educate yourself about, how does the market move, do your back testing and all that type of stuff. In 2 years, it makes a huge difference, and you can already tell where's price going to be headed and where the type of words that they're going to be using in these monetary policies, things like that. But if you're someone who's kind of doing on and off and you're not putting the time in, then you should, if you want to trade interest rates or even NFP, then you should be following what Steph is saying, which is, trade the reaction to the news. Don't end up trading the news. That's the level. That should be enough motivation for you guys to just, making sure that you're putting the time in every time you're trading, and if you really want to be here for the long haul.
100%.
Quick question, guys.
Yep.
You know how well, I think they say 95% of forex traders are actually speculators on the retail side, and then 5% are actually your banks or whatever.
Yep.
But however, that 5% controls the 95% of volume in the markets.
Yep.
That wild swing that we see during the news release and so on, those wild swings, are they caused by the banks?
Yes.
Or are they caused by the speculators?
No, us speculators, us retail traders, we don't move the market.
Yeah.
At all. Those are the banks, and they're positioning themselves, because they're going to get the same information and as we're going to get. Basically, it's just that they're been doing this for such a long time, they understand, where some of these key areas. They're the ones who are moving the markets. That's why it's so important to understand that as a retail trader, your 1 trade, 2 trade, 3 trades is not going to do anything in the markets, right? It's peanuts. And so that's why you're not trying to catch tops, you're not trying to catch bottoms, you're not trying to do any of that. Your job as a retail trader should be trying to just ride the wave as it's happening.
Because I won't lie, I was wondering, like, how do the banks make money, and how do they even permit such wild ass moves? So that's what I was, just like contending with.
Yeah, look at those. That's why, you look at those higher time frame levels, and it starts to become clear that which levels are the most important, right? And where you see majority of these sell-offs and the massive push up and everything like that happening, and those are the liquidity areas. In order for you to continue to move, for example, we're gonna go over US 30 in a little bit, right? And I'll show you guys and I'll break down those levels for you guys and everything. But if you're looking at US 30, for example, hop up to the monthly time frame, right, and look at what was 28,800 level, and look to the left. That's where that massive sell-off came from back in 2020. Even after providing that liquidity, the market still reacted to that level. That was a liquidity level, right? And then ever since, August, we already knew that we were still going to come in quite aggressive with the interest rates. The market was already starting to price that in, yet we grabbed that liquidity from that higher consolidation in that 34,000 level, and then we continued pushing down with a straight sell, essentially coming down into 28,800 level, right? And then after that entire rally back up that happened last month, that's to grab liquidity, and once again coming back into those liquidity areas.
Yeah, I'm taking a look at it now.
Mm-hmm.
Guys, I'm sorry, just a quick break. Is financial just acting up for you guys at all?
Let me pull it up.
Just on my side.
No, it's acting up.
It is?
Yeah.
All right, good. Because I just, I've been going back and forth setting up my Wi-Fi and everything. I just had to get an extender for the basement.
Uh-huh.
And I thought I was having issues again.
It did the same thing last time too. I think it's just the high volume.
Did it? Okay. And maybe for once we actually stick with Force Factory. All right. Before the statement comes out, anybody have any other questions? I think that was a great question, Pat. I think a lot of people wonder that.
Yeah, for sure.
But yeah, I think if you got 1,000 of us in a room together and we each were trading with 20 grand, that wouldn't even move the market. Even if we all took the same exact trade.
Yep.
I guarantee that it wouldn't even touch the market.
Yep. Can I go ahead and break down US 30 real quick?
Oh, yeah. We got 6 minutes. Do you want to share your screen?
Yeah, I'll do it. Right. Alright, let's start off with the quarterly real quick. So these are the key levels I would be marking off here, which is that support area. This is what I'm talking about here in 2020, where you got that nice little top wick, and that was a massive sell-off. Even after that liquidity that was provided here, we still end up reacting to this level, which you'll see here on the monthly time frame, right? That's how you're going to figure out whether is this a key level or not. If you can continue breaking below this, this is your next key level. Look at the levels that price keeps tapping into, rejecting, and it still cannot break past that. So here's your first rejection. After that, it still took us a couple of months until we finally broke above it, but it was quite weak. And then you come back and tap into it once again before finally continuing back up. And then you see a further sell-off coming right back into this area. That's how you tell that this is a very strong level, because price keeps tapping into it. Same exact thing here. Once we approach this level, since it was such a strong level where you had a massive sell-off happening, there's no way that price is just going to continue dumping below this, right? You had to come back. You have to grab more liquidity, especially going into the next year or so, where we know that they're going to continue increasing rates for a sell-off. If you were to sell off from this point, the Fed would 100% be stepping in once again like they did back here and providing more liquidity, which you cannot do if on one hand you're contracting the money supply, you're moving into contraction monetary policies. You cannot expand the money supply by injecting more money into the economy or into the financial markets. It just doesn't work like that. You're doing two contradicting things at the same time, which is what happened with the UK, When you're looking at GBP JPY, for example, where the Bank of England had to step in and they had to provide liquidity into the markets, and that caused such a huge fear into the markets and into the investors, where you saw that massive volatility. So same exact thing right here with the US 30, especially in the equities market. That's the last thing that you ever want, where you want the investors to be fearful and just seeing massive sell-offs and things like that happening, right? So before the Fed even steps in, which we know that they will, eventually it's going to happen probably later next year or the year after that, but eventually we're going to get to this point down here and we're going to end up providing more liquidity into the financial markets. Probably not all the way down here. Very rarely do we ever see like new highs being formed and then the lows coming back and tapping into previous lows, but we could probably come back. We're going to come back below 28,000 level for sure before the Fed steps in and provides liquidity once again. Now when you drop down to the monthly time frame, that's when you start to see all of this a little bit more clearly, where you have all this consolidation that's forming here. You finally try to break above it, but with very little volume, push up, and this is where in 2020, this is when you start to see those sell-offs happening. And in March, that's when the Fed stepped in. And a lot of times, if you guys remember, whether it was Robinhood, TD Ameritrade, anything else that you guys were trading, they legit said that you couldn't sell certain stocks, right? That was pretty much the interjection of the Fed stepping in and saying like, okay, you cannot sell any more securities and we're going to end up providing more liquidity. Even after providing that liquidity back here, we come back into the levels back in like, September, and you still end up reacting off of that to hold on to a support, and that's when that rally up happens. So same thing here, when in September you saw that massive sell-off happen here, there's no way that you can continue breaking below this without getting more liquidity. Also notice how we haven't really even broken past this entire level. This is a very strong level. This is where the market keeps holding on to a resistance, and even in October we just made a little bit of top wick, and even this month we haven't necessarily broken past this level. We just made a top wick. Now that's not to say that we can't come up a little bit higher. We probably could to grab even more liquidity. You're coming around holiday times, and obviously they're not going to come in as aggressive as the investors would like them to control inflation, but they're still going to come in with those 75 basis point hikes, right? And then can we see a potential sell-off to come back into these areas? Around the holiday times, you're going to start to see some of this volume dying down a little bit anyways. You drop down to the weekly time frame, and you see this nice bearish trend. It's still going to continue, right? Nothing's really changing here from a higher time frame perspective. Price is still creating these lower lows and lower highs. It's just that can we hold on to this resistance here and then continue pushing down? So here I'm going to mark off the bottom wick of the current weekly candle, which is going to be this 32,500 area. And then if price can continue breaking below this, then we're looking for those continued sells, potentially turning some of the scalps into swing trades. The next level that I'm really interested to see how price is going to react is going to be this level right here, into this 31,500. Drop down to the daily. So last couple of daily candles, starting off the week, we're already holding onto a nice strong resistance. Today, clearly there's a little bit of volatility here. We're not breaking highs or lows. And so this is coming from the fact that, again, it's such a high impact day where you have interest rates coming out. But there's a very high chance that we can come back as the press conference is happening, as interest rates are coming out, come back into this area, grab more liquidity prior to a continued sell-off. So that's why it's so important to wait for the press conference. When you drop onto the 4-hour, you got all this consolidation. So again, there's a very high chance that you could come back and tap into this area before another sell-off. So what you need to see here before you look for any sort of buys or sells is a clear break of this bullish structure, which only happens if price can continue below this. All yours, Steph. Go for it.
All right.
There you go.
Yep. We have a move. Liquidity grab. What was the rate?
75.
75, as expected. Oh, there he is. What's up, Andy?
What's happening?
Not much, man. How you doing?
I'm doing great. Wait for this.
Did you ever rent that Lambo?
What's that?
Did you ever rent that Lambo?
No.
I'm talking about your story the other day with the electrical box.
Yeah. No, it's actually one of our down a couple doors down from our business office. It's one of our business suite neighbors. He just happened to be at Lowe's that day too.
He's got the what was it? The electrical box that charged a Tesla.
Yeah, no, no, it's like a transformer.
Oh, okay.
No, it just happened to be the Urus parked next to it with a sign that said, $19 for the first 90 minutes. But he actually works down the street from the same parking lot from our business office. So he's one of our neighbors.
Nice.
Yeah.
Is that
That
the
is
Corvette
nice.
that one of your coworker brings in, Andy?
What's that?
I think it's like one of the Corvettes that you're always posting. Is it the Corvette or is it something else?
No, that's my cousin's. That's
okay.
mortgage company. That's theirs.
Oh, okay.
Yeah.
So real quick, guys, let's go back real quick. If you guys look at, let's go to the folder over here. Last time they increased rates in September of 21, what we ended up getting here was September 21. You take a look right here. We were actually kind of consolidating over here at the time, right? They increased rates at 2 o'clock, right? Price ends up breaking a resistance, and then we fake that resistance out, and price completely corrects that move over here. So can we expect something similar with what we got going on over here with this resistance, right? Can we get like maybe even a fake out? If price closes back into this range, I would definitely be playing the sells coming back down and correcting this move here. That's kind of how you play the history. Now, if we end up closing above this area, right, and then holding the support right in this area to retest the high, if you get that strong close bullish in this area, you can very well take this thing up, and that's the ideal entry that we normally take anyway. Instead of taking the fake out, you're taking the break and retest with a fairly clean move to the left right over here that you can mirror this thing up and grab a little scalp out of the market. We'll see what ends up happening, especially with the press conference, but that's basically how you look at. That's how you backtest.
It's pretty much a Super Bowl day for traders.
Yeah. This is it. This it is. Who we got in here?
All right, we're just gonna be a little bit more patient.
Yes. Let's see what we got. We got Justin in here. Justin, you ready for the new Yellowstone season? Not if you heard me. Any questions on YouTube? Oh, we got Muhammad Ali on YouTube. I like that.
The greatest.
Yeah.
Who is trading right now?
What's up?
Who's trading right now? I hear MT4 in the back.
Who was it? Whose microphone took over here?
Y'all are getting exposed. We just told you not to trade.
I'll be honest.
Full margin.
I was just gonna say, I'll be honest. I just full margin my account. Oops. All right.
Someone's getting a margin call from their broker right now.
Hello.
We need you to bring in $40 million.
Is this you?
The IRS has been looking for you, sir. Please stop trading.
Yeah. One of our 89,000 agents is after you now. And they're armed.
I was late to your assessment or your breakdown, BJ, but there's a part of me that thinks there's a huge psychological wall at 33,000. I mean, I can see a case for 33,250 just from a bearish trend perspective, but 33,000 is like such a psychological barrier for some people.
Yeah, so that's what I was
saying. I don't know if it
saying.
matters, though. I mean, relative to everything happening, I don't know if anyone cares.
That's what I was saying. Like, if you hop up on the daily real quick, Steph, for me, please.
US 30 or gold?
US 30.
Okay.
So that's what I was basically saying, that I'm going to annotate here real quick, where price was pretty much bearish at that time, and then it was kind of like ranging around this area. So that's what I was saying, that we saw the same exact thing happening back in September too, where we could see a pushback up into this area, which is a strong level when you're looking at the weekly, monthly levels. And then can we see a quick little fake out, a little bit maybe higher than this, grab more liquidity, and then come right back down?
Yeah. It's weird because there's a no man's land between this 33,000 and 33,250. There might just be too many people at the top trying to stomp it down. I don't know.
Can you zoom out a little bit more, Steph?
Yeah, I was just trying to read Javad on YouTube trying to answer his question.
Oh, no worries. No, just right there is fine.
Okay.
So
Yeah,
what
I
I'm
see
looking
it.
at, so what I'm looking at is this entire level,
Yeah.
right? And then you just extend that over to the left, this entire area right here. So can we see potentially maybe a little push up right into this area and then a continued sell, which is going to
Yeah.
help test that structure up top here as well for this entire bearish move down.
Yeah, 100%. That'll be that third tap right in that key area.
Mm-hmm.
We just tank from there. I found it interesting. We're getting very similar price action that we got back in November of 2020.
Mm-hmm.
Happy holidays.
Yeah, right. You see the market. Maybe this is what that optimism is.
Yeah.
Also, it's. I don't know. I don't see too much optimism in our economy.
People searching for an exit.
Yes.
See, the hard thing is that when you're just a consumer and you don't really think about investing and stuff like that in general, it's very hard for you to think like an investor, right? And then when you're an investor and you trade and you've been part of the financial markets for such a long time, you understand essentially what's happening and what to even expect, then it's hard to even think like an average consumer, right? But I think to be successful in the financial markets, you have to think about both, because as an investor, what you're essentially trying to do is capitalize based off of the sentiment of the market, but also what would an average consumer do.
Yeah.
Right. And I think that's the hardest part. But once you kind of understand, you got to put those two pieces of the puzzle together for you to be successful long term into the markets here.
Yeah.
Unless you're trying to be a long-term trader, which is just position trading or swing trading and stuff like that.
Hey, you go down to the 1 minute, 5 minute, that 33,000, it keeps getting
rejected. Yep.
Yeah, but I mean we're talking extremely narrow, thin time frames here.
Yeah.
We could easily break through that. I mean, was the market expecting 100 basis points and we didn't get it?
That was what there was just a discussion of it. It was not more of an expectation, so to speak.
Yeah. Exactly. It would have been a major surprise either way, but the way the market's reacting to gold, to the dollar, to US 30, to the stock market, all looks like they were really expecting maybe a 100 basis point increase.
The thing is if we actually ended up doing a full percentage hike, 100 basis point hike, that means in December you can't do another hike. Because now, going into, let's say, February or March, which is what their target range is for, you're already going to be too close to it, right? And so you won't have enough room to really make any adjustments as needed. Versus you do a 75 basis point hike now, and then you do a 50 basis point hike in December. Mm-hmm. Now you have the next 3 months to let the effects pretty much trickle through all sectors of the economy and all participants of the economy, and then adjust your policies according to it. A 25 basis point hike, not going to happen, right? But 50 basis point hike, or do we continue with the 75 basis point hike? Or do we even need to increase our target range because we're not seeing inflation come back down from a 4 to a 5% target range to up to a 6% target range?
Yeah.
I think 75 is perfect. Just keep it at that.
Mm-hmm.
Yeah, I think this is the market getting what they were hoping for. 75 now, 50 later, and then easing in February and March. Or not easing, slowing down the rate increases to 25s.
That's more of what I was saying. Maybe they weren't expecting a 100 basis point increase, but at the same time, it is kind of good news that they weren't doing that. I don't know if that makes sense, but that's what it looks like.
Yeah.
We shall see. We'll see what Powell says. That's all that matters. All right, guys.
It's so fascinating how the decision-making process is pretty straightforward in developed nations.
Yep.
Where you don't have to contend with higher levels of unemployment and poverty. As opposed to in the developed countries, increasing interest rates on the people are what the fuck are you doing? We're starving. We don't have jobs. But then the government is well, we're trying to control inflation, and so there's this it's almost like there's this standstill almost of okay, what do we do? You know, so yeah, it's just been fascinating.
Yeah, thank you for bringing that up, because when I was trying to do the fundamental breakdown, I forgot to mention, it just like completely slipped my mind, but thank you for bringing that up, where another discussion around now, like with the Fed increasing the rates, and then also specifically the part about in December, can you see another 50 basis point hike or a 75 basis point hike? Now the next question that a lot of people have, like investors and like in general, like everyone in the economy has, is for the US, if you continue being so aggressive, we understand, like, you know, we haven't really come up to like the 4% interest rates in like quite some time, right? And so if now you're increasing your target range to, let's say, interest rates being above 5%, then what does that do for the rest of the global economy? So we know that the recession is coming, and we know that there's a lot of countries who are being hit hard. And then is there going to be like some sort of a spillover effect internationally from what the Fed is doing? And I think that's where majority of the concern is also coming in from.
Yeah, definitely. So like some of the rhetoric over here in South Africa is like, you know, the central bank is pretty much saying, well, we're going to have to adjust our rates, you know, in accordance to what the U.S. is doing, because it pretty much affects, you know, I mean, we import a lot of stuff, you know, from you guys, and the spill-on effect is just massive for developing nations. So you sort of have to follow suit, you know, but then you have to contend with the reality that your people are, you know, already hungry, and poverty levels are bad, and, you know, unemployment is bad, and not a job that I want, that's for sure.
No. Definitely shaky in developing nations.
So we should all just start like a podcast together.
Yeah, right? We could talk for days on this.
The speculator economists.
Yeah.
Armchair economists.
We are the Fed. It's us.
Yeah.
Monday morning trader.
Yeah, there you go.
Monday morning economist.
Yeah, Monday morning quarterback.
What was I? I was gonna bring it. I feel like I always bring up football analogies, but I had a perfect one before with what was it? Living to fight another day. Talking about not trading the news, and if you know you don't take a trade today, obviously journal the trade that you missed that you would have taken. But you know, don't try to force anything today. Live to fight another day. It's the same thing as a quarterback in a game. You know, take that check down. You see all your receiver. I don't know if anybody follows football in here and understands what I'm talking about, but you know, understand the fact that you can live to fight another down, especially if you have a good defense. You know, just throw the ball away. Throw it to your check down. Live to fight the other down. Same exact thing with you guys as a trader with your accounts. Live to fight another day. Live to trade another day. So you don't blow your account on news. Wait for your setups during a little bit less volatile times, and stay smart.
You know what we should do? We should do one of the podcast episodes with just like a normal conversation like we're doing right now, and just get like the input of what everyone is seeing from like different countries. I think that'd be quite interesting, because I just got this idea with like Pat talking about, you know, their central bank also saying like, you know, we have to follow what the Fed is doing, and then we have people from like the UK here. We have people from like all over the place. I think that'd be pretty cool.
Oh yeah, we could start with Pat.
Yeah.
Have Pat on.
Everybody hop on.
Talk about what's going on in Cape Town.
We do another Zoom call with like 25 people.
Yeah, right? That'd be awesome. I was thinking we might get that pullback here on gold, but looks like the market is really reacting to the 75 basis point increase. We could get the pullback during the press conference, but right now we're
yeah, because you're setting that little daily consolidation too for gold if you hop up to the daily time frame.
Yep. Yeah, this is all a mess right here.
Yeah. The entire thing is a daily consolidation. What I have marked off is, let me annotate real quick, this entire area right here, and then I also have exactly the zone that you have. So all of this in between, all of that is just consolidation. If we can break past that, potentially looking for, let's say, some sort of a bottom wick here, and then a continued push up, come up to 1680, capitalize off of that, and then look for continued buys coming. I do think that we could come back up into 1700 for sure.
Yeah, if he mentions anything about a possibility 50 basis point increase in the next 15 minutes, you're going to see this thing rally and starting to break some structure over here.
Yeah.
All right, because that's
I don't think it's gonna. I don't know if it would happen exactly like right now with interest rates and everything, but I'm saying like for the next couple of months or so. But what I do want to see before, I'm definitely like more inclined to take buys here. But what I want to see is price pull back a little bit closer to like that 1660 area, make some bottom wicks, and finally break out of this consolidation prior to any buys.
Oh, okay. So you're waiting for the break and retest, basically.
Yeah.
Yeah. So wait, again, that's what I was saying before. With if we end up, this level right here, 1658, is pretty important. Obviously, 1660, it's a psychological level. But if we pull back into here and then end up closing back below that area, you're going to see some kind of a correction of this move. But if we end up holding support right there, then you might have a nice move because now you're getting a high created, right? We're getting a pullback just like we had multiple times right over here. After breaking this resistance, you get that heavy pullback, and then price ends up rallying, retesting the previous high. So you could expect the same exact thing here, where price ends up retesting 1668, and then eventually 1676, continuing right back up, breaking structure around 1680, which is that main level on the monthly that we've been looking at for years now, actually. Right? Sharma and I have been breaking 1680 down for a long time, so if somehow we end up breaking above 1680, 1700 over here, that'd be very interesting.
Mm-hmm.
I don't think it's going to happen, but
I think we could continue pushing above that at least to come into 1750 because that's a massive sell-off that has happened. And I think...
I'm sorry, Sharma.
And just with the fear of not even the fear, it's just like pricing in the fact that there's the recession and everything like that happening, I think we can continue pushing up into 1750 for sure, and then create like a lower high and then continue the sell-off as things do start to get a little bit better and you start to get more positive macroeconomics coming out.
Maybe like a pullback like we got in 13?
Yep.
We already broke structure like we did right over here, right? We already broke that bullish structure where we kept retesting 1680, 1700 over here. We already broke below that and closed below. So maybe are we coming up to retest that area and then continue down? That all depends on how the market reacts to the rate increases in the next couple months and years. Like I don't know if I see anything like this happening because we're raising rates in a recession right now. This was a recovery from a recession, right? This was a recession, right? A lot of fear in the market, price pushing up, rallying all the way to 1900 over here. Mm-hmm. And then we, from 2009 to really 2012, 2013, we really started to consolidate over here, obviously, and then correct some of this move. And then we ended up breaking support over here. And then 13, we ended up getting a more stable economy. And that's where we started to come down. And then 16, a lot was going on in 16. Trump was elected. Then you got a lot of tension between North Korea. If you guys remember that, Iran. And then we had the trade deal with China, which pushed us up over here. We had almost World War III with Iran, if you guys remember that. And then we had, obviously, COVID, which pushed us all the way up here. So right now, rate increases are going on right now. But in a recession, if we hold support and continue right back up, with a market crash, you could very well see the support being held and we continue through 1700 and continue right back up with a high price of gold.
Check out the 15. Yeah, I'm looking at that on the 15-minute. A nice rejection right into that.
That bullish whip up actually closed below the consolidation on the 15-minute.
On US 30, Steph.
Oh, okay.
Yeah, 32,930.
That was such a nice rejection right into that 33,000 and then pull right back.
Yeah, see, that consolidation left you on the 15 minutes
from
earlier in the session today. Yep, that closed below that.
100%.
Oh, yeah, interesting.
We got
You
9
guys-
minutes before the press conference comes out, so now it's gonna get fun.
Yeah.
Confused.
You had this consolidation going on for about 10 minutes over here. We finally broke below, created a low, retesting that area. Now we're retesting this area down here, possibly, unless this is a fake out and we continue right back up and continue the rally.
Look
But
at you on that
33,000,
1
I
minute chart.
agree. What's up?
Look at you on that 1 minute chart.
Yeah, man. Look at that little snipe here. Nah, I'm still getting used to US 30. I love it though. I caught a nice sell this morning.
I was tempted to enter this sell as on based off like the 5-minute time frame as that 33,000 was getting rejected, but I was like, I'm gonna wait for the press conference.
Gotta practice what we preach.
It's that, but it's also then I hopped up to the daily time frame and I'm like, regardless of whatever happens in this range, as soon as this daily low is broken, it's a straight sell that's coming. So why not just be a little bit more patient and catch that than try to be impulsive?
Yeah, I agree. Let's see. Yeah, that's a nice strong 5-minute close over here, but again, this could end up being a fake out. But you would need to close below 33,000, and then you could take this thing up.
See, something that I could see happening here with the press conference and all that is like coming right back into that consolidation, tapping into that maybe that 33,000 range a little bit more with like some wick rejections and whatnot, and then seeing a sell-off. What you were saying, like around 3 p.m. Eastern time?
Mm-hmm.
Somewhere around that.
Yeah, that's what you guys want to wait for. Just get his sentiment, and maybe it only takes 5-10 minutes to really understand what he's trying to say. And after that first 5-10 minutes, he's probably not going to change much from what his rhetoric is. So you might be able to grab a trade there. But generally around that 3 o'clock time frame is where you could really trade that trend.
Oh, yeah, look at this.
Sharjeel, Kyung,
10-year yield.
Carlos.
Andy
my
is
gosh,
having so
Shauna.
much fun right now. I just hear him in the back, the 10-year yield.
What's that?
I said Andy is having so much fun right now because I could just hear him in the back saying 10-year yield.
Loves those bonds.
Nerd stuff.
I love it. Because I'm looking at the same exact thing.
Yeah, it's retesting 4%.
Yep, I'm looking at the same exact thing, Andy. We're on the same boat.
Rejection here on gold. Oh, just consolidating right now, waiting for the press conference. Got about 7 minutes.
The thing is that even on this 10-year yield, it's a level that we have never tapped into until, what was this, 2009?
Yeah, you gotta go way back.
Yeah, 2008, 2009. That's the last time that we tapped into this 10-year yield.
Those are good times for housing.
Yeah.
I'm just kidding. Everybody listening, it was terrible.
Go on the monthly stuff.
Yeah. There you go.
Yeah, see, the last time we tapped into that, yeah, that's good right there. Yep.
And you look at the rate at which we got there is insane.
Yep. There we go.
Look at this, just straight.
Yeah. If you triangulate it from its low in August 2020 to now, you're talking 26 months, and it has 8-fold increase in its price from 0.5% to 4%.
Wild.
That wreaks havoc through lending everywhere. Good time.
Yo, Andy, did I see something about mortgage foreclosures already up 700%?
Well, but don't let that get ahead of you. Think of that in terms of it being its like all-time low after they suspended eviction moratoriums. Or I'm sorry, after they had eviction moratoriums.
Yes, that caught up.
If there was 1 last month and there's 7 this month, it's a 700% increase, right?
Mm.
So it's not like you went from 1 million to 7 million.
Sure. Okay.
Yeah, so it's all proportional.
I saw that number. I was like, oh, it hasn't even started yet either.
Yeah. No, it's again, it has to be highly connected to not interest rate. It's directly connected to people's ability or inability to make their monthly payment, which is going to come back to labor.
Mm.
So when the Fed is signaling we need to see unemployment at 4 to 5%, that's still another 1.25 million to 1.9 million jobs potentially on the chopping block.
Yeah.
Assume half of those are renters, half of those are homeowners. You know, there's your number for potential foreclosures.
Not gonna be pretty. All right.
See, that's the like the way that Andy explained it. That's like perfect because it's the same exact thing with like the CPI data that we get. Same exact thing when you're looking at any percentage numbers that are coming out, where we start to see like that drop. Let's say the previous was 0.6, they're forecasting a 0.5. Nothing that doesn't no worries. That doesn't mean that that particular data, whatever's coming out, is slowing down. From a 0.6 to a 0.5, that does not mean there's a decrease. That just means that it's still increasing, but at a slower pace than it was last time. Yeah. In order for you to see a decrease in, any of the economic data that comes out in percentages, you need to see a negative number coming out. A 0% just means that it stayed at the same. That's why it was so funny. I forgot which one it was, but when Biden came out, I think it was CPI data. It was set at like 0% or something like that, or PCE maybe. And then Biden comes out, he's like, we don't have inflation.
No inflation. Like,
that's
no inflation. Imagine.
Not how math works.
I think if we keep rejecting this area over here on gold, you could see some kind of a correction where price could come right back down to this level, and that's what you want to see is retest of 1658, and we can continue up.
Those are 5 minutes? Oh no, you're on the minute.
This is a 1 minute, yeah. 5 minute. Right now, you got some weak bearish candles, but if we fail to break through these areas over here, I could see us correcting part of this move at least. But right now, we are holding support and pushing through. Question is, can we push all the way through? 1666. Too many sixes.
The fun thing about this is fundamentally nothing's changed.
Yeah.
Yeah.
The only thing that's changed is the sentiment that they're going to, go to 50 basis points in December and then slow it down. But that's still very hopeful. All that means is that even since March when they started, they're still not done, which means it'll take all those lagging months for us to finally see the outcome they're hoping for.
Mm.
So if we're 9 months removed from their 8 months removed from their first move, then in 8 more months' time, we're going to start seeing the effects of that.
I don't think we're going to 50 next month.
What's that?
I don't think we're going to 50 next month. I think we're staying at 75. But who knows? We'll see what he says today. Got about 1 minute left. Do you guys want to watch the press conference together, or do you want to...
I'm watching it for sure. I'll hang with you guys.
Yeah. Okay. Yeah, same.
So let me pull it up.
This is where I picked him up saying, next year and the year after that. Like it was nothing. Like, wait a minute. You're talking about 2023 and 2024.
Mm-hmm.
Try to squeeze that in there, Papa Jerome.
Papa Jerome.
Yeah. Or Papa Pow.
Papa Pow. It sounds like a kids, some kind of kids show on Nickelodeon. Papa Pow.
Yeah.
Basically what they're trying to make it out to.
Yep.
That's the sound he makes on the market. Pow!
Yeah.
Oh, they have real cheesy music going. Great.
So how can we do this?
Oh, here we go. I hope Steve Leeson asked him a hard question today.
I'm gonna keep it muted so we can't hear.
You can put on the subtitles.
Yeah. No, we can. Yeah, that's a good idea, actually.
Oh, there it goes, VJ, crossing 33,000.
It's all good. We're excited.
Gold held support.
I'm definitely expecting push above, coming right back into that little range of like 33,250, 33,000.
Yeah, let's hold on. Get on. Now we're good.
Here we go.
Can you guys hear?
My colleagues and I are
Yeah, somewhat.
inflation back down to our 2% goal.
Dope.
We have both.
So while you guys are listening to this, I'm gonna say that drop down to like the 1 minute, 5 minute time frames and legit look at how the market reacts to everything that he says. So all he's reading out right now is that monetary policy, which we already know, what they're saying and what to expect, this and that. I think the craziest thing that you're going to end up seeing is when they actually start asking him questions.
Mm-hmm.
So next 30 minutes, just sit back. Don't look for any trades. Don't try to trade anything. Just wait and watch how the market is actually reacting to everything that he's answering.
Already talking about the strong labor.
Increases will be appropriate. We are moving
Sufficiently restrictive. Woo!
sufficiently restricted to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance on policy for some time. I will have more to say about the monetary policy actions after briefly reviewing economic development. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth in spending and production this quarter. Growth in consumer spending has slowed from lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower monthly also appear to be weighing on business-facing investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs, and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending September, total PCE prices rose 6.2%, excluding the volatile food and energy categories, where PCE prices rose 5.1%. And the recent inflation data, again, have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food, and has created additional upward pressure.
The fact that they keep saying the same thing over and over again in every press conference.
Mm-hmm. The same speech.
Copy paste.
Just recycles it.
What if he goes, oh, wait a minute, this is September, sorry.
That's what I said last time. It's Groundhog Day.
Russia and Ukraine just looking at him sideways.
Yep.
The Fed's monetary policy actions are guided by an objective to promote maximum employment and stable prices for human beings. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet.
Which he was just touting the number, excluding food, like 2 seconds ago.
We are highly attentive to the risks that high inflation poses to both sides of our mandate. And we're strongly
Andy's getting ready to fight him at this point.
At today's meeting, the committee raised
Andy's warming up.
75 days. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in forming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in rate-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increase as we approach the level of interest rates that will be sufficiently restricted to bring inflation down to our 2%. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And
Did you just see that?
Yep. Gold.
And US 30.
I mean, US 30 is still kind of bullish for me, at least.
No, it just dumped 300 points in a minute.
Just wait for it. Just wait for it. Let the
Delayed.
let the questions come.
Yeah, right?
No, I'm not jumping after it. I'm just saying, look at that minute candle. That is steep.
So that it comes into better alignment with supply. Our overarching focus is using our tools.
Oh, that's nasty.
Yep.
Expectation is well anchored.
Hey, look at that hourly candle.
Ridiculous.
Some softening of labor.
That's why it's so fun. Like, I love watching the markets like on lower time frames, only when like interest rates are coming out in the press conference.
Me too. It's fun.
Yep.
So can we close below here, 1658 on gold? Just like we did in September.
To conclude, we understand that our actions
Get the fake out.
Everything we do is in service to our public mission.
You guys can still hear, pal?
Yeah.
Employment, price stability goal.
Oh, the 10-year.
Here we go.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a contingent on a string of
Oh my.
specifically now and let's say the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lag effect that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for.
PCE.
We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
George Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow it.
Stefanos.
Would you say that the bias right now is not for another 75 basis point increase?
Yo, Steph.
Yeah.
What I want to do.
Andy was saying something.
Case in the context of our broader tightening program.
What's up, Andy?
Talk about the statement language.
Do you want me to pause it?
So I think you can think of our
No, just keep it going. What were you saying, Andy? Oh, he's talking about December.
How fast to go. Second is how high to raise our policy rate. And the third will be eventually how long to remain at a restricted level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we've raised that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. We put that into our post-meeting statement because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover, but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lag between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third question. And that's why I've said in the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, as in the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Steph, you want to move the thing to the side a little bit for US 30? Look, we're tapping into it once again. Yeah, dropping down to the 5.
On an annualized basis.
To the 5-minute time frame.
Running
5,
in the high fours, close to 5%.
Look, we're getting closer to that 33,000 once again. That's round 2 right there.
Leap above that level to be confident that you are imparting enough restraint to bring inflation down.
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchdown, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of it, at the federal funds rate, for example. So households and businesses, they're very meaningfully positive interest rates all across the curve for them. Spreads are larger, so borrowing rates are significantly higher. And I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I can follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. There are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level for sure, substantially above for some time, they'll see it move up, but the movement will be fairly gradual. So I think that's what principal models would tend to say. But I wouldn't want to limit it to one assessment. There are many different, as you know, people publish an assessment of underlying inflation.
Thank you for taking our question. Gina Smiley, New York Times.
Great question.
The stage that inflation is, or the risk becoming entrenched.
Is inflation becoming entrenched? So, I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit in the middle part of this year. They moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that
Andy, look at the 10-year yield now.
Yeah.
I guess the other thing I would say is that the longer we have, we're now 18 months into this episode.
We're inching back up.
And we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tool forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington.
Has he hinted at smaller hikes?
Yes, he did. Basically, when he keeps saying sufficiently restrictive, that essentially means that we're already towards the end of it at this point. Like, we can't really be as aggressive as we were hoping to be. That's basically what that essentially means. And so you could probably see one other 75 basis point hike, but I do think like coming into December, they're probably going to drop down to 50.
Okay. Because all I keep hearing is more so, obviously, inflation is public enemy number one. We're going to do whatever it takes to combat that.
They've been saying that forever.
Exactly. So, I mean, I guess he's hinting at slower hikes, but...
Mm-hmm. Well, it's one of those things, like those who get it, get it.
Interpret, yeah. The way people interpret it.
Yep.
I don't know if Jay's looking at this over here, but we ended up closing below 1658 here in the 5-minute.
Yep.
Flipping bearish, passing the low of the previous candle, and correcting this whole move. Just like what happened in September.
Mm-hmm.
Right, we got the fake out of this level of the consolidation. Price ended up continuing right back down over here.
But also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is highly uncertain. And so, from a risk management standpoint, it would be irresponsible not to ignore them. But you want to consider them, but not take them literally. So I think it's a very difficult place to be. But I would tend to want to be in the middle, looking carefully at what's actually happening with the economy. And trying to make good decisions from a risk management standpoint. Remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, employment costs in particular, will be much higher potentially. So, from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
I have to follow up. Should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lags. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's a
Ooh.
Let me say this. It's
Very premature to think about pausing.
very premature to be thinking about pausing. So people, when they hear lags...
You're a little bit ahead of us, huh?
Very premature to
Your US 30 chart is also different from mine, Steph. Mine is just tanking.
Is it?
Yeah, I'm on the
Yeah,
5-minute too.
I was actually exploring that before, too, seeing...
I was at 32,500 or something.
Yeah,
there you go.
32, 575, 550.
As soon as this 4 hour continues breaking its own low, so 32,500, I'm in for sales.
32,500, yeah.
Yep.
Yeah, right there. Jay, do you see my chart over here?
Oh, wow, BJ.
So you're already in once broke the level. Yeah, so once we ended up creating that top wick, flipping bearish and passing the low of that candle, we closed below with that candle right there. You lower your risk on something like this, but put your stop loss right up there, lower your risk, enter as soon as it passes the low, anticipate the further correction of this move. I secured 80% at about, hold on, I'll get to the press conference in a second. About 50 pips, 46.
Even Hugo's way is lagging a little bit.
I'm gonna close the full thing here. Alright. And that's how you trade the news.
So I also took a trade, but like I said, Hugo's way is lagging a little bit. So I want to enter at the break of 32,500. Give me an entry. It's lagging by 100 points. Is that happening for you too, Andy?
I'm at 32, 450.
Okay, well I got at 32,595.
Why?
Oh, yeah, I'm sorry, I'm not in. I'm saying my chart's there. Yeah.
Oh, okay. I got in at 32,595, and then I just took some partials as we're breaking below that, just so I can enter again with a bit more risk.
Yeah.
We love interest rates.
We're even though he's still talking, we're coming up on that hour close too.
Yep.
Well, half hour.
Really, and then after next 8 minutes or so, as this just continues pushing, that's when I want to re-enter.
After a retest?
After this candle closes, and then the next one gives me a top wick and continues pushing.
I don't know why I'm typing this right now. I could just say it, but Jay, great job staying out. If that, if it scares you, and if you're too, I don't know, you just don't want to be in news. You feel like it's gambling, which you're right if that's the case. But eventually, over time, you're going to start to realize that there are moves to catch after the news comes out, and that's called trading the reaction to the news. That's not so much gambling as it is when you're just in the press conference and just randomly taking a buy, randomly taking a sell, or placing your sell stops and buy stops. Right? That's gambling. You have no idea what's going to happen. And we still don't have any idea what's going to happen when it comes to trading, and you don't need to really know what's going to happen next. You just need to know what the high probability of what's going to happen next is. So we've seen this many times. One thing I was exploring here on the 15-minute is I've seen this where we get that strong bullish close, you get a weaker bullish close right over here, then this candle ends up creating that top wick and then flipping bearish and passing the low of that candle. That would have been a possible entry right there for you to take. Now this is, again, I can see how that can be daunting to somebody, but that's more advanced. And eventually, the more you start to backtest these moves, the more you're going to start to see stuff like that happen. Was someone trying to say something?
Yeah, I took a trade, but it aired out on me, so the trade is still going, but I can't close it or modify or do anything.
Who's your broker?
MetaTrader.
MetaTrader. Well, no, the broker. That's your platform.
I mean the platform. It's Hugo's way.
Hugo's way. Okay. And it won't let you close the trade out?
No, I can take another trade, but the
of course you can.
That's really weird. When you press on close,
wow,
you're not able to modify how much you want to close?
No, I just got screwed because I had $100 in profit and now it's gone back to -1.
That's weird because I have the same broker and I just took some partials too.
I don't know. I can take
you need to contact your broker, man.
I pretty much am getting screwed right now.
Yeah.
It's just running live, but I can't do anything about it.
Try closing it out on your phone.
Okay.
Yeah.
Oh,
it might be MetaTrader. It might be your MetaTrader.
It just let me close right now.
On the phone?
No, on my iPad.
Did you lose a lot more than you planned on?
No, I mean the slot was pretty small. Well, at least I ended in profit though, thank God.
Oh, okay. All right, you didn't lose anything.
No, I didn't lose anything.
Okay. You made it sound like you're blowing your account here.
No, I put it if it kept on going.
Yeah.
Woo, that was intense.
Get a winning trade. Screw you. We don't want to help you.
I mean, I had $100 profit, but that's gone down to like 40 something.
Oh, okay. Well, that happens.
We need
Yeah, I would even...
Bloomberg terminals.
That was the most I put in the trade before.
Yeah, Jay, that's exactly what you want to do. Just trade the reaction to the news, like we've been. I think we said it like 10 times on the stream, just to make sure you guys do it. Wait for that. I would say the initial part of the press conference and then the beginning part of the questions. If you get that initial feeling of what he's trying to say and his sentiment, then you can start trading whatever you think. But generally, around this time, 3 o'clock, you're trading the trend around that time, and that's what you want to wait for every time these. Every time the FOMC does their press conference. So I ended up closing the full thing right over here. Right here. 92 pips.
Good stuff.
Quick little scalp. But do you see what I'm saying up here? If you guys go back and back test gold after FOMC press conferences and other things too, but I've seen this set up so many times where we get that full correction of this move, and then we saw it a month ago, right? So, but I do like this setup over here. The only issue is like, where would your stop loss be, right? If you were to take that impulse entry, and it is risky, right? But you're playing that rejection. You're playing the move down. I'm just gonna say something. I forgot what it was.
All right, do you want to look at the US 30 chart? Sure. I want to break down another potential entry here. All right, hop back up to the daily, please.
Sure. I was just about to ask you, VJ, about scaling.
Yeah. All right, so I'm going to annotate this is good right here. Okay. So the level that I'm looking at is we've already rejected this, which is perfect. Grab that liquidity, continue pushing down. Now, if you want to look for an entry, what you need to see is wait for price to break below this area. So we're rejecting into this, which is pretty much the previous daily low. Now, if we can continue pushing below this, then you got those potential sells to come back even lower. Can you mark off these two levels for me real quick?
Of course.
Perfect. Now let's go ahead and drop down to the 4 hour. Alright, so now on the 4 hour time frame, this is pretty much all the interest rate news that just came out. Massive top wick rejection, continue pushing down. Really what you need to see is as long as this candle can close below this, you're good to go. Now in the next candle, what you want to see happening is still a top wick or so, because now the volume is going to start dying down. You're at the end of New York session, all that stuff. London session pretty much is over as well. And so now you need that little bit of a top wick, and then as price continues pushing, then you're going to come back and target into this area for potential TP, partials, whatever it may be. If you don't have a top wick on this candle, don't look for an entry just yet, because that is a lot of uncertainty and a lot of volatility in the markets with these two massive top wick and bottom wick rejections. Now we're going to drop down to the 1 hour, please. Alright, so on the 1 hour, same thing. Nice bottom wick rejection, came back. You're essentially trying to break these previous lows. Now all you need is, once again, wait for this candle to close below this area, at or below, and then the next one to give you a top wick. There's a very high chance that price could pull back a little bit deeper, maybe up top here in the next couple of hours or so, which is perfectly fine because that's a lot of sell-off pressure that just happened, right? And then continue that entire sell-off. The point being is that we know that there's going to be a sell-off happening here. Drop down to the 30, please.
Yes.
All right, so here you had that entire sell-off from press conference, from interest rates, all that stuff from that 30. Yeah, there you go, from that 33,000 mark. Now this candle is the new hourly candle. It's gonna give you that nice top wick that you're looking for, and then you look for those potential sell-offs. Anywhere coming back when you're looking at the 30-minute time frame, anywhere into this area, you're okay. right? Even if it pushes up a little bit higher, I would say as far as like maybe this area, you're okay. If it pushes back up higher than this, then don't look for a trade opportunity, because all of this is probably going to be consolidation, liquidity grabs, all that type of stuff, and then a continuation. Remember that on Friday we still have NFP. So you have good opportunities, maybe in the next like an hour, 30 minutes to an hour, and then wait for NFP to come out.
I would also like, if this candle does create that top wick and then flips bearish, if you do take that sell right over here to fill that wick, understand that we could be coming into somewhere in this area, and then you're going to get that pullback. So understand the limitation to your trade, because we could be retesting this area and then continue down. So just watch where you place your stop loss and the way you manage your trade. I would be grabbing profits somewhere around this wick fill and then also that previous resistance.
Mm-hmm. All right. Any other questions? You guys feel confident?
Just really well done, guys.
All right. Thank
Appreciate
you.
it.
All right.
Getting better every time, man.
Absolutely.
All that matters. Stay consistent, keep improving.
All right. So if you guys have any questions, you guys know where to reach out to us on Instagram at SharmaFX or at StefanosFX for Stefanos. Other than that, have a great rest of the week, everybody, and make sure that you guys are trading safe. Don't end up over trading or anything like that. But yeah, we'll see you guys soon next week.
Absolutely. If anybody on YouTube, I know you guys are all already in our group, but anybody on YouTube, if you guys need help, feel free to reach out to us. If you want to go over this further, feel free to reach out. We're here to help. All right, we're not gonna bite, so just come out, shoot us a message on either one, and we got your back. All right.
Yeah. So, just as a reminder, my mentorship intake has closed on Monday. It's the last day of October, and it's gonna open back up in 2024. So for the next entire year, I'm not taking any more student intakes. But Stefanos, I guess your mentorship is still open, right?
I'm taking 5 more in the next 2 weeks. So
Okay.
if somebody wants to come in, by next year, prices are going to be increasing. So if you guys want to hop in now, and then obviously everyone that's already in is already grandfathered in. But if you guys want to, and if you qualify, we got to hop on the Zoom first, see if you guys are qualified. But I'm taking 5 more for the next 2 weeks. So if you guys are interested, let me know, and we could get started on your career.
All right, awesome. Yeah, so but even if like my mentorship is still closed, if you guys have questions, just feel free to reach out on Instagram. More than willing to help you guys out. But other than that, have a great rest of the week, everybody.